Chapter 2, Securities and Taxation Regulations. You'll notice Chapter 2, 23 questions comes from this material. Folks, this makes up 1/4 of the exam. 100 question test, 23 questions, not quite a quarter, but close enough. This makes up a quarter of the exam. You will not pass this test if you do not know the information in Chapter 2. There's so many questions in this section, you can't be weak here and strong elsewhere and make up for it, okay? So this is an important section. Let's go ahead and take a look at some things we're going to be covering here. We're going to talk about Federal Securities Act in this chapter. Federal Securities Acts include the Securities Act of 1933, the Securities Exchange Act of 1934, the Investment Company Act of 1940, the Investment Advisors Act of 1940, Securities Investor Protection Act of 1970, and Insider Trading and Securities Fraud Enforcement Act of 1988. Now, you do need to know these acts. You've got to know what they're called, and you need to know what they do. And we're going to be talking about what they do in detail. We start with the Securities Act of 1933. Now, the Securities Act of 1933 is known as the Paper Act, known as the Paper Act. You may also see this referred to as the Act of Full Disclosure or the Prospectus Act. The Paper Act, also known as the Act of Full Disclosure, also known as the Prospectus Act. Now, the Securities Act of 1933 regulates the new issue market, regulates the primary offerings. Now, what's the difference between a new issue, a primary offering, and a secondary offering? When securities are sold and proceeds from the sale of the securities goes to the issuer, that would be a new issue or primary offering. Now, the Act of 33 requires new issues to be registered with the federal government. Now, this is why it's called the Paper Act, because the Act of 33 requires that certain papers be filed with the federal government to register the new issue, There are some securities that are exempt from registration under the Act of 1933. That would include municipals. So municipal bonds, those GO bonds, revenue bonds, those IDRs, do not have to be registered under the Act of 1933 with the federal government. Also exempt from registration would be government new issues. The T-bills, the T-notes, T-bonds don't have to be registered with the U.S. government. Next exempt would be banker's acceptance. Now, this is as long as the maximum maturity does not exceed 270 days. Next would be commercial paper. Again, maximum maturity does not exceed 270 days. Now, we talked about BA and CP when we talked about money market securities, and we talked about the fact that the maximum maturity of those was 270 days. Now, on the test, they might try and trip you up and say commercial paper was issued with a maximum maturity of 280 days. Well, that is not going to be exempt from registration. So be careful of stuff like that. Also exempt from registration under the Act of 1933 would be private placement. Now, this would be a new issue made in connection with Regulation D. So on the test, they might say a new issue made under Reg D or in connection with Reg D is known as the answer, private placement, and this is exempt from registration with the federal government. Now, a private placement can be sold to no more than 35 non-accredited investors. No more than 35 non-accredited investors. Now, who's a non-accredited investor? That would be individual investors. You, me, individual investors. Now, the private placement can be sold to an unlimited number of accredited investors. Now, who is an accredited investor? This would be institutions like banks or mutual funds. Who else would be accredited? That would be insiders of the issuer. Who else would be accredited? This would also be individual investors whose net worth is $1 million or more. That excludes the primary home, or individuals filing a tax return as a single filer with income of $200,000 each of the past 2 years and expects the same this year. If it's a married couple filing a joint tax return, then that number jumps from $200,000 to $300,000. Now be careful here. Be careful here. There's one net worth, whether a single filer or a married couple filing jointly. There's only one net worth here, net worth of $1 million or more, whether you're a single filer or you're a married couple filing a joint tax return. But when we start looking at income, now there are two different income levels. Someone filing a tax return as a single filer has the income requirement of $200,000, and the person married filing jointly $300,000. Let's kind of run through some numbers here. Let's say that we have an investor whose net worth is $1.25 million. Their income as a single tax filer is $150,000. Are they going to be considered an accredited investor? And the answer is they are. They are. The income didn't get them there, but the net worth did. You'll notice there on the slide it says individuals with net worth $1+ million or individuals who have this income. So it's either of those. Either of those. How about this? We have an investor who net worth is $750,000. They're married. They file a joint tax return. Jointly, they earned $250,000 each of the past 2 years. Expect to do the same this year. Are they accredited? No, they're not. They didn't make it on the net worth, and they didn't make it on the income. Well, Dave, you said $250,000. I did, but I also said that they were joint tax filers. So that $200,000 would not come into play here, but it would be the $300,000 number. This would not be an accredited investor. These people, this investor, would fall in the category of a non-accredited investor. And a private placement can be sold to no more than 35 non-accredited investors. Okay? So be careful of that. Be careful of that. We continue with the Act of 1933. The Act of 1933 requires full and fair disclosure of all material facts about the new issue. Well, we just learned why the Act of 33 is also called the Act of Full Disclosure, because all material facts must be disclosed. All material facts of the new issue must be disclosed. This is accomplished by way of a prospectus. Well, we just learned why it's also called the Prospectus Act. Prospectus Act. Now, all material facts must be disclosed. Do all facts have to be disclosed? Absolutely not. Only those facts that are material regarding the new issue. Now, what makes a fact material? Any fact about the issuer, any fact about the new issue that would affect an individual's decision to invest or not is a material fact. The educational background of the CEO, a material fact, that would influence my decision to invest or not. The mailing address of the issuer, that's not a material fact. So the address being wrong in the prospectus or left out of the prospectus would not be a problem. Okay? Now the Act of 1933 is designed to prevent fraud. Designed to prevent fraud. Prior to 1933, there was all sorts of fraudulent activity taking place in the securities industry and was perfectly legal. But no more. No more. Now, the Act of 33 requires a prospectus to be delivered. Now, timing is important. This prospectus would have to be delivered at or before solicitation. At or before solicitation. So you're going to go and you're going to talk to a client about a new issue. You have to deliver the prospectus at the time of solicitation, at the time of your meeting, or before that meeting. You could not deliver the prospectus after the meeting. You would be in violation of the Securities Act of 1933. Now, you'll notice that if it's an unsolicited trade, in other words, you didn't recommend the trade to your client brought the trade to you, said, I want to do this. If it's an unsolicited trade, then the prospectus must be provided no later than with the confirmation, which means no later than the settlement date. Now we move on to the Securities Exchange Act of 1934. Now, this is known as the People Act. This is known as the People Act. This act created the people the paper is to be filed with. This act created the people that the new issue registration document is to be filed with, and that would be the Securities and Exchange Commission. So the People Act created, the Act of 1934, created the SEC. Now, what else did the Act of 34 do? The Act of 34 requires registration of secondary markets. The New York Stock Exchange has to be registered. The American Stock Exchange has to be registered. Also, the Act of 34 requires broker-dealers to register with the federal government. Also requires representatives to register with the federal government as well. So the Act of 1933 requires new issues to be registered. The Act of 34 requires everybody else to be registered. Now, there are people who are disqualified from registration. People who are disqualified from registration are statutorily disqualified. Who would be statutorily disqualified? There's our list. Convicted of a felony within the past 10 years. Now, you murder someone. 20 years later, you want to come into the securities industry. Would you be statutorily disqualified? No, you would not, because that conviction was more than 10 years ago. Now, I don't think a broker-dealer is going to hire you, but you're not statutorily disqualified under the Act of 1934. Who else would be statutorily disqualified? Convicted of a securities crime within the past 10 years, and that would include misdemeanors. If you have willfully violated a Federal Securities Act, if you've been expelled or suspended by an SRO, such as FINRA, or maybe a state regulator, if you're subject to an order denying, suspending, or revoking registration, you're statutorily disqualified. Now we move to the Investment Company Act of 1940. Now, we're going to talk about the Investment Company Act of 1940 in quite a bit of detail when we talk about chapter number 5. Right now, we just want to kind of hit the highlights. The Investment Company Act of 1940 regulates investment companies. Now, there are 3 types of investment companies. There's the face amount certificate company. Now, on the test, you may see this referred to as the FAC. There's the unit investment trust. You might see this referred to as the UIT. And then there would be the management companies. Now, there are 2 types of management companies. There's the open-end management company, which is the mutual fund, and there's the closed-end management company, and that's not a mutual fund. Now we look at the Investment Advisors Act of 1940. Investment Advisors Act of 1940 requires registration of investment advisors. Now, on the test, folks, expect to see investment advisor referred to as an IA. IA. There have been quite a few abbreviations here that we've looked at over the past 2 chapters. You're asking yourself, do I really need to know these abbreviations? And the answer is yes, you do, because they'll be used on the test. So, what is an investment advisor? An investment advisor, an IA, charges a fee for giving investment advice. If the client follows the advice, fine, the advisor gets paid. If the client doesn't follow the advice, fine, the advisor gets paid. Now, when we get our Series 6 license and we start talking to clients, will we be giving investment advice? We will. I recommend you buy this, recommend you buy that. Are we paid for that investment advice? We're not. We're paid based on a transactional fees. Therefore, if the client doesn't take our advice, if they don't buy what we're recommending or sell what we're recommending, we're not paid. We're not paid. Therefore, we're not an investment advisor. We are a registered representative. Now, registered representative. On the test, expect to see that referred to as an RR, registered representative. Now, the IA. The IA registers with either the SEC or the state. Now, the broker-dealer has to register with the SEC and the state. The register rep has to register with the SEC and the state. But the investment advisor registers with either the SEC or the state, not both. Not both. Now, what advisor would be required to register with the SEC? If an advisor manages assets of more than $110 million, they must register with the SEC. What if the advisor manages assets of less than $100 million? They must register with the state. Now, there's a gap there. The gap is between $100 million and $110 million. Who would those advisors register with? Their choice. They would register with either the SEC or the state, but not both. But not both. Now, who's excluded from the definition of an investment advisor? Banks, lawyers, accountants, teachers, engineers. Great way to remember lawyers, accountants, teachers, and engineers would be an acronym LATE, L-A-T-E, lawyer, accountant, teacher, and engineer. Now, be careful. They're excluded from the definition of an advisor as long as any advice they give is incidental to the services they're being paid for. What does that mean? Here's what it means. Let's say that you go to an accountant to prepare your tax return. You're going to pay the accountant to prepare your tax return. They do. They recommend you buy municipal bonds. Now, have they given investment advice? They have. They've recommended that you buy municipal bonds for tax-free income. They've given you investment advice. Did you pay for that advice? You did not. You paid for them to prepare your taxes. So the advice they gave you was incidental to what you paid for. You paid for your tax return to be prepared, not for the advice. That accountant would be excluded from the definition of an advisor. And since they're excluded, they would not have to register. Now, different scenario. Let's say you go to an accountant and you ask the accountant to help you put together an investment plan. What should I buy? What should I sell? When should I buy? When should I sell? Now this accountant is going to give you investment advice and you're going to pay for that advice. That accountant would be defined as an investment advisor and would have to register with either the state or the SEC. Who else is excluded from the definition of an investment advisor? That would be the publisher of a periodical that is in general and regular circulation. In other words, if you can go to a newsstand and buy the periodical, the publisher of that periodical is not an investment advisor. So Money Magazine would not be an investment advisor. Wall Street Journal would not be an investment advisor. However, if you subscribe to a periodical that is not in general and regular circulation, and the information in this periodical is specific to your investment needs, now this publisher would be defined as an investment advisor and have to register. Now me, I like option trading. I love option trading. I subscribe to a newsletter that gives me information specific to option trading. This newsletter is not in general and regular circulation. The information I get from this newsletter is very specific to my investment needs. The publisher of this periodical would have to register as an investment advisor. Next federal act is the Securities Investor Protection Act of 1970. Now, the Act of 1970 is designed to protect customers in the event of broker-dealer failure, broker-dealer bankruptcy. The Act of 1970 created the Securities Investor Protection Corporation. On the test, you're going to see this referred to as SIPC. Now, SIPC provides coverage per separate customer, not account. Coverage is $500,000 in securities and cash with no more than $250,000 coverage for cash. What if you have securities or cash beyond the limits? Then you would have to go to the bankruptcy court and file beyond the limits as a general creditor. Let's take a look at an example here. So let's say that John Doe has an individual account with $200,000 in securities and $300,000 in cash. Now, we talk about cash, we're talking about a free credit balance, not money in a money market fund, but free credit balance. How much coverage under SIPC? Well, he's got $500,000 in coverage, of which no more than $250,000 would be cash. So the $200,000 of securities would be covered. His cash position is $300,000. Coverage there is limited to $250,000. So he's got $450,000 of SIPC coverage. Now, he's got $500,000 in assets. Only $450,000 are covered by SIPC. What about the other $50,000 not covered by SIPC? He would have to go to the bankruptcy court and file as a general creditor. Okay, general creditor. Let's take a look at example number 2. Take a look at 2. John and Mary Doe have a joint account. Now, John, in example 1, had an individual account. John and Mary Doe, in example 2, have a joint account. Joint account's got $30,000 in securities, $40,000 in cash. How much coverage under SIPC? All of the assets would be covered. Well, wait a minute. John was the same customer in example 2 as in example 1. Would he have the same coverage? Remember, coverage is per separate customer, not account. Since example 2 has an account registered in a name different than example 1, example 1 was John Doe as an individual account. Example 2 is John and Mary Doe as a joint account. So we've got 2 different accounts registered differently. Then we would see John as 2 separate customers, and he would have coverage under SIPC. What if John had an individual account, John Doe had an individual account with a broker-dealer, and John Doe also had an IRA with a broker-dealer? 2 different accounts, both registered in the name of John Doe. He would be seen as 1 customer in that case, 1 customer. Now let's talk about Insider Trading and Securities Fraud Enforcement Act of 1988. Insider Trading and Securities Fraud Enforcement Act of 1988 deals with trading securities using inside information. Now, before we go any further, let's define inside information. Inside information is simply information that's not available to the public. Now, is it illegal to have inside information? Absolutely not. People have inside information all the time. Officers, directors, employees have information about a company that's not available to the public. So it's not illegal to have inside information. What's illegal is to use that information to buy and sell securities. Now, who would be guilty of insider trading? That would be using inside information to buy and sell securities. That would be the tipper and the tippee. Person who divulged the information, person who acted on the information. Let's say that I am the officer of a publicly traded company. My wife and I have a party at our home one evening. We invite some friends and neighbors over. We're going to drink adult beverages, grill out burgers and brats. During the course of the evening, I mentioned that my company is going to announce earnings next week, and these earnings are better than expected. Is this information available to the public? It's not. We don't announce earnings till next week. Neighbor overhears the conversation. On Monday, they go out and they buy stock in the company. Later in the week, we announce our earnings, better than Wall Street expected. Stock price goes up. Neighbor sells the stock, makes $100,000 on the trade. Is the neighbor guilty of insider trading? Yes. Am I? Absolutely. But I didn't know what the neighbor did. You're right, but I should have known the information was not available to the public, and I shouldn't have been talking about it. Now, if the broker-dealer and registered rep also knew the customers trading on inside information, they would be liable as well, but they'd have to know that to be liable. Now, what are the penalties? There's the civil penalty and there's the criminal penalty. The civil penalty, you'll be fined up to the greater of $1 million or 300% of the profit made or loss avoided. Now, on the test, you'll see that 300% referred to as treble damages. So the fine is going to be the greater of $1 million or treble damages for profit made or loss avoided. So my neighbor made a $100,000 profit. he would be fined the greater of $1 million or 300% of that profit. So the greater of 1 million or 300,000, he's going to be fined $1 million. So am I. What else is going to happen to us? In addition to civil penalties, there's also criminal penalties. In addition to paying the fine, we're going to go to jail for up to 20 years. Up to 20 years. Now, I want to be sure we're clear here. Insider trading includes both profit made and loss avoided. So let's say that someone has inside information about a company. There's bad news that's coming. That news is not available to the public. When it does become available, stock price is going to fall. I sell my stock in advance of that bad news, not to make a profit, but to avoid a loss. That's insider trading as well. Now we're going to talk about the new issue market. New issue market. Proceeds from the sale of securities goes to the issuer. Mentioned this a bit earlier. We have the new issue or the primary market, and we have the secondary market. What's the difference between the two? When securities are sold and proceeds from the sale of securities go to the issuer, that's a primary market transaction. Now we're going to see later that when the proceeds go to someone other than the issuer, that's a secondary market transaction. Now, who are the people who are involved in the primary market? The first would be the issuer. The issuer is going to be selling securities to raise capital. Who's the other person involved in the primary market? The other person involved would be the underwriter. Now, this is also known as the investment banker. An underwriter or investment banker is nothing more than a broker-dealer that's going to help the issuer register their new issue with the federal government and then market that new issue to investors once the new issue becomes effective. Now, there are several different types of underwritings. The first type of underwriting is best efforts. The next is all or none, and the third is mini-max. Let's take a look at each of these. Now, best efforts underwriting. This is where the underwriter tells the issuer, listen, we're going to make our best effort sell as much of this new issue as we possibly can to investors. So the underwriter is going to act as a broker or agent for the issuer. And the issuer has the financial risk. If the shares are not sold, the issuer is the one who has the financial risk. Now, what if it's all or none underwriting? So all or none works like this. Underwriter says, we're going to make a best efforts underwriting. Issuer says, fine, but understand this. If you don't sell all the new issue, we're going to sell none of the new issue. Issuer needs to raise $50 million for a project, and they're going to raise this money by selling a new issue. If they can't sell all of the new issue, if they can't sell enough to raise $50 million, then they're not going to sell any of it because they can't move forward with the project if they cannot sell all of the securities. So they don't want to sell any of them. So again, the underwriter is acting as a broker. They're acting as an agent. They don't have the financial risk. The financial risk rests with the issuer. Now, underwriting could be mini-max. Underwriter goes to the issuer and says, we're going to make our best efforts and sell as much of the new issue as we possibly can. Issuer says, fine, but understand this. If you don't sell a minimum of the new issue, I'm going to sell none of it. So maybe the issuer is trying to raise $50 million. If they get $40 million, they move forward with the project. They'd like 50, but $40 million, they could move forward with the project. So the issuer would say to the underwriter, fine, we're going to do a mini-max. If you can't sell $40 million of the new issue, I'm selling none of it. And of course, the max side would be the most that we intended to issue to start with. Now with mini-max, the underwriter is acting as a broker. They're acting as an agent. They have no financial risk. If the shares are not sold, the financial risk rests with the issuer. The next type of underwriting is standby. Standby. Now here, the underwriter is acting as a dealer. They're acting as a dealer. They're going to buy the new issue, put it in their inventory, mark it up, and resell it. They're acting as a principal. So dealer, principal means the same thing. Here, if the new issue doesn't sell, it's the underwriter who has the financial risk. Firm commitment. Firm commitment. Here, the underwriter is buying the new issue from the issuer, marking it up, reselling it to the public. So once again, the underwriter is acting as a dealer, which means they're acting as a principal. The underwriter has the financial risk if shares are not sold. Now, what's the difference between standby and firm commitment? Here's the difference. Standby underwriting is used with preemptive rights. Standby underwriting would be used with preemptive rights. Now, is it possible? Well, first of all, let's go back and revisit preemptive rights. Preemptive rights allow us to maintain a proportional ownership if new shares are sold. So existing shareholders could buy the new issue. Existing shareholders could buy the new issue. So let's say that I own 3% of a company's shares outstanding. The company's going to issue some new shares. Preemptive rights allow me to buy 3% of those new shares to maintain my proportional ownership. Every stockholder, common stockholder, has the right to maintain proportional ownership. So it's conceivable that the entire new issue will be sold to existing shareholders. Existing shareholders will exercise their preemptive rights, and all the new issue is sold to existing shareholders. It's possible. Unlikely, but possible. With a standby underwriting, the underwriter tells the issuer, listen, you go out and you sell the new issue to your existing shareholders on preemptive rights. Any shares that you don't sell, we'll be standing by, we'll buy them from you. And firm commitment is simply where the underwriter buys the entire new issue, marks it up, and resells it to the public. Now, that's the primary market. Secondary market. Secondary market is where we trade shares that are outstanding. These would be shares that were previously issued. Now, what is a secondary market transaction? This is where proceeds from the sale of securities goes to someone other than the issuer, which means the proceeds go to investors. Primary market transaction, proceeds from the sale of securities went to the issuer. Secondary market transactions, proceeds of the sale of securities goes to someone other than the issuer, which would be investors. There are 4 secondary markets. The first is the exchange. The exchange, New York Stock Exchange, American Stock Exchange. There's a physical location. There is a brick and mortar. There's a building. What trades on the exchange? Stocks and bonds that are listed on the exchange. This is an auction market. The person on the exchange who's responsible for maintaining a fair and orderly market, which means matching up buyers and sellers, is known as the specialist. Now, again, it's the auction market. It's the auction market. Okay? Now, let me kind of illustrate that for you. I'm a specialist for a listed stock. I have an order to sell 200 shares of ABC. There are floor brokers who work on the exchange. Their job is to get orders filled for their firm's customers. We have a dozen floor brokers, one specialist, me. These floor brokers are trying to buy the 200 shares that I'm selling. Anybody give me 20, give me 20, give me 20 and a half, 20 and a half, 23 quarters, 21, 21, 21 and a half, 21 and a half, 21 and a half, sold, 21 and a half. That's an auction, and that's the way the exchange operates, auction market. The next secondary market is the over-the-counter market. Now, on the test, expect to see this referred to as the OTC. The over-the-counter market is an electronic market. There is no physical location. It's an electronic market. What trades over the counter? Securities that are not listed. So unlisted securities trade over the counter. In fact, folks, most securities are unlisted. Most securities trade over the counter. Now, this is not an auction market. This is a negotiated market. The party who is involved in this market is not the specialist. They're the market maker. A market maker is nothing more than a dealer, broker-dealer, It's nothing more than a dealer that's going to provide market liquidity. Now, what does that mean? Here's what it means. Let's say that I'm a market maker in an over-the-counter stock. I provide market liquidity. I tell investors, if you're looking to buy, come to me, I'm selling. If you're looking to sell, come to me, I'm buying. So the market maker provides market liquidity. Now the market maker is going to advertise their prices and inventory on a computerized quotation system known as NASDAQ. Now let's kind of talk about the difference between the auction market versus the negotiated market. I explained the auction market to you a while ago. Let me explain the negotiated market. I'm a broker-dealer. I'm not a market maker in an over-the-counter stock. One of my customers comes to me to buy an over-the-counter stock that I don't make a market in. I go find the market maker. Now, the market maker has a quote to sell the stock at $30 a share. My client wants to buy the stock for $29 a share. So I call up the market maker. Remember, it's an electronic market, telecommunications market. Hey, market maker, you're looking to sell for 30. I've got a client who wants to buy for 29. Will you take 29? They say, no, but we'll take 29 3/4. I go, customer, will you give him 29 3/4? Hang on. Market maker, will you take 29 1/2? Now, what are we doing? We're negotiating a price. And this is the negotiated market. The over-the-counter is where we find the negotiated market. Now, you notice that I was a broker-dealer that was not a market maker. I was going to find the stock for my customer, which means I would be acting as a broker for my customer. And I did find a market maker who had the stock. And I knew the price that they were selling the stock at. How did I know the price they were selling at? I got a NASDAQ quote. That's the computerized quotation system. Now, the third secondary market is known as the third market. It's also known as the NASDAQ intermarket. Now, what trades on the NASDAQ intermarket? This is where listed securities trade over the counter. Now, somebody is asking, why would listed securities trade over the counter? Why wouldn't they just trade on their exchange? Better price over the counter. But there's something we need to be careful here. While listed securities can trade over the counter in the third market, over-the-counter securities can never trade on an exchange. The door only swings one way. Listed can go over the counter, but over the counter can never go listed. And the fourth secondary market would be the fourth market, also known as the Instinet. This is where we would have direct institutional trading. This is where banks would be buying and selling amongst themselves, mutual funds buying and selling amongst themselves, pension trusts buying and selling amongst themselves. There's no broker-dealer involvement in the fourth market transaction or in the Instinet. Let's talk about prices. There's the bid price, the ask price, and the spread. The bid price, the ask price, and the spread. Now, the spread is the difference between bid and ask. That's the profit the market maker will make. That's pretty simple. Now, bid and ask. Folks, you're going to see questions on this test. You're going to need to understand what the bid and ask prices are, and you're going to have to understand who does what with bid and ask prices. Always approach bid and ask price questions from the customer's perspective. I don't care if they're asking about the market maker. Approach it from the customer's perspective, because if you figure out what the customer does, the market maker does the opposite. So let's take a look here at the bid price. The customer sells the bid price. That's money they receive. Who buys from the customer? The market maker. That's money that they pay. Now, the ask price. Customer is going to buy the ask price. That's what they pay. The market maker is going to sell the ask price. That's what they receive. So they're going to ask a question like this. Customer goes to a market maker to buy a stock. The market maker will receive what price? A, bid. B, ask. approach this from the customer's perspective. If you figure out what the customer does, the market maker does the opposite. Answer here would be ask price. Now we move to taxation. On this test, there are several types of taxations we're going to talk about. We're going to talk about tax on ordinary income. We're going to talk about tax on capital gains and losses. Not there, but we're also going to talk about tax on gifts. We start with capital gains and losses. Capital gains and losses. We have to establish a cost basis to find out if we have a gain or loss. What is the cost basis? This is money that has been invested that you've paid taxes on, after-tax dollars that have been invested. Gains can either be realized or unrealized. Losses can be either realized or unrealized. What's the difference between realized and unrealized? Let's say that I buy a mutual fund for $10 a share. That's my cost basis. The price of this mutual fund rises to $15 a share. I don't liquidate the shares. That's growth. Since I haven't liquidated those shares, that's an unrealized capital gain. And that's not taxable. That's not taxable. What if I buy mutual fund shares for $10 a share? The value increases to $15 a share, and I redeem my shares. This is a realized capital gain. Since I sold the securities, this capital gain has been realized, and this would be a taxable event. Now, can I offset my gains and losses? Absolutely. And I can do this offset dollar for dollar. Do this offset dollar for dollar. Once I do that offset, I end up with what's known as a net loss. Of that net loss, I can write $3,000 off against my ordinary income. And if there's any net loss in excess of $3,000, I can carry that balance over to the following tax year, and there's no limit as to how long I can carry that remaining net loss over for. Next year, year after that. Let's take a look at an example here. Let's say that we have a $15,000 capital loss for the year, and we have a $10,000 capital gain for the year. Our income is $55,000. First thing I'm going to do is I'm going to take $15,000 of that loss, and I'm going to offset that against the $10,000 gain. I have no tax liability on the capital gain. This leaves me with a $5,000 net loss. Leaves me with a $5,000 net loss. I can take $3,000 of that net loss and write off against my income of $55,000. So that reduces my taxable income to $52,000. I have $2,000 of that net loss that I have not used, and I can carry that over to a later tax year, and there is no time limit as to how long I can carry it. And that brings us to a wash sale. A wash sale, kind of an odd name, wash sale. With a wash sale, the IRS will disallow a loss if the same or substantially identical security is purchased or repurchased within 30 days of a sale that resulted in a loss. This is based on trade date and results in a 61-day time period. 61-day time period. Let's take a look at an example of what we're talking about here. Okay? Now, you see that we have a trade date of 3/20/2012. On that date, I sold XYZ stock for $1,000 loss. If I had bought XYZ within 30 days before, or if I repurchase XYZ within 30 days after, I cannot write off the loss. It's a wash sale. I cannot write off the loss. So let's say that I sold the XYZ for a $1,000 loss on 3/20. I had bought that XYZ stock on 3/1 of the same year. 3/1 of the same year. I could not write off the loss because that sale was within 30 days of the purchase. Let's say instead I bought the XYZ stock several years ago, sold it for a $1,000 loss on 3/20, and on 4/2 I buy XYZ back. Cannot write off the loss. That's a wash sale. So there's your 61-day window. Trade date plus 30 days before and 30 days after. 30 days before, 30 days after. Now we mentioned something about a substantially identical security. What is a substantially identical security? That would be a call option. That would be rights, warrants, convertible preferred, and convertible bond. Convertible preferred, convertible bond. So if I had, instead of purchasing the XYZ, if I bought the XYZ call option, or right, or warrant, or convertible preferred stock, or convertible bond, that would be a wash sale also. And here's the reason this would result in a wash sale. I can take each of those 5 things and I can turn them back into that which I sold for the $1,000 loss. I could exercise the call option for the stock. I could exercise the right for the stock. I could exercise the warrant for the stock. I could convert the preferred stock for the common stock. I could convert the bond for the common stock. So each of those would allow me to get back that which I just sold. Now you'll notice in the note here, bonds and preferred stock are not substantially identical unless they are what? Convertible. So if you bought preferred stock within that 30-day window or a bond within that 30-day window, not a problem, not a problem, unless the preferred stock or bond was convertible. Now let's talk about the cost basis of shares transferred. There are 2 ways to transfer shares. We can do this by inheritance, or we can do this by gift. Now, if shares are inherited, that means that the owner has passed away. They've died. Cost basis on shares inherited would be the fair market value of the shares on the date of death. This is known as the stepped up or stepped down basis. Now, if the shares were transferred by gift, then the donee would use the donor's original cost basis as their cost basis, and gift tax limit applies. Now let's take a look at some examples here. Let's start with inherited. Let's say that we have a client who bought stock for $10,000. That's their cost basis. That's money that they invested, they've already paid tax on. The value of the securities grow to $15,000. That's the value of the securities on the date that the owner of the securities dies. Now, the heirs or the estate later sell the securities for $20,000. They have to establish a cost basis. And under the inheritance tax rule, they would use the value of the securities on the date of death as the cost basis. That's the stepped up basis of $15,000. There would be a $5,000 capital gains that would be taxable to the heirs or to the estate. Now let's take a look at what would happen if these shares transferred by gift. Again, we've got a $10,000 cost basis. Securities grow in value to $15,000. That's the value of the securities on the date that a gift is given. So let's say that I buy $10,000 worth of stock, grows in value to $15,000, and I give the stock to my son. I'm the donor. My son is the donee. The donee later sells the stock for $20,000. The donee has to establish a cost basis. Under the gift tax rule, the donee would use the donor's cost basis, the original cost basis, as their cost basis. So here we've got a $10,000 capital gains that would be taxable to the donee. Now the donee, the person who received the gift, did not have to pay any tax on that gift until the shares were sold. Now, the value of the gift was $15,000. Under the gift tax rule, I could give gifts as a single tax filer of $13,000 per person per year and pay no gift tax. Well, the gift that I gave was $15,000. The gift limit is $13,000. I have given $2,000 in gifts, beyond the tax limit, beyond the gift limit. This $2,000 would be taxable to the donor in the year of the gift. Taxable to the donor in the year of the gift. This is the gift limit, $13,000 if I'm a single tax filer. If it's a married couple filing a joint tax return, then that number jumps to $26,000. $26,000. And this is per person per year. So this would be per person who the gift is given to. So let's say that my wife and I, we're married, file a joint tax return. We have 5 children. How much could we give to each of those children every year and owe no gift tax? $26,000 to each child every year and owe no gift tax. Now let's talk about retirement plans. Retirement plans, we're going to talk about the traditional IRA. We're going to talk about the Roth IRA. We're also going to be looking at the non-qualified plans. Now, non-qualified plans do not need IRS approval. Money going into a non-qualified plan would be after-tax dollars. So you've already paid taxes on the contributions. Money grows tax deferred. You don't pay tax on the earnings until there's a distribution. Now, these plans are non-qualified, which means they can discriminate. They can discriminate. These plans could be offered to some employees, but not all employees. So non-qualified plans are employer-type plans. Non-qualified plans include deferred compensation plans and 457 plans. Qualified plans would be a next group. Now, qualified plans require IRS approval. Money going in would be pre-tax contributions. In other words, I put money into these plans before paying taxes. Cannot discriminate. So if an employer is going to offer a qualified plan to employees, they've got to offer to all employees who would qualify. Now, not there, but I'm going to ask you to make sure you're clear on the money in these plans grow tax deferred. Don't pay tax on the contribution amount or the earnings until the money is withdrawn. Now, plan types include the Keogh plan, that's the HR 10, the simple plan, the defined benefit plan, the defined contribution plan. Now, defined contribution plans would be a money purchase plan, a 401k plan, or profit sharing plan. Next, we have 403b tax sheltered annuities or tax sheltered accounts. On the test, you will see these possibly as TSA. Now, we're going to talk about these in detail. So let's go to the next slide. We're also going to be looking at these educational accounts, including Coverdell and the 529 plan. Now, Coverdell Education Savings Accounts, on the test, you might see these referred to as ESAs. All right, so let's kind of dig into the details regarding these retirement plans. We start with the traditional IRA. Now, contributions. What can you put into a traditional IRA? You can put in 100% of your earned income up to a maximum of $5,000 per year until the age of 50. Now, if you work and your spouse does not, you could open up a spousal IRA. Now, this is like an umbrella account. Within the spousal IRA, there are 2 individual accounts, one for the working spouse, one for the non-working spouse. What's the maximum I could put into the spousal, the umbrella account? $10,000. Now, when you reach age 50 years, 50 plus, you could put in an additional $1,000 as a catch-up amount, so the maximum would be $6,000, and in that spousal umbrella account, the maximum would be $12,000. Now, there would be no contributions allowed past the age of 70 and a half. No contributions allowed past the age of 70 and a half. Now, a couple of things we need to talk about here as it relates to contributions. I can put 100% of my earned income into a traditional IRA. Earned income, this is money that you make from work. It's your salary, it's your commissions, it's your bonuses. But not all income is earned. Some income is unearned. Unearned income is known as passive income. What would be unearned income? Money that you make from investments, money that you make from real estate, Social Security benefits, child support, spousal support. This is income, but it is unearned, and that income cannot be contributed to a traditional IRA. So let's say that my total income for the year is $50,000, of which $3,000 is earned. $47,000 unearned, $3,000 earned. How much could I put into a traditional IRA? Not the $5,000 maximum, but I could put in 100% of my earned income, and that was only $3,000. Only $3,000. So watch for that. Earned income versus unearned or passive income. Distributions, taking money out of your traditional IRA. If you take money out of your traditional IRA before 59.5, not only are you going to have to pay ordinary income tax on that, whatever your ordinary income tax rate is, you're also going to have to pay a 10% tax penalty, 10% tax penalty. When you reach 70.5, you're required to start withdrawing money from your traditional IRA. These are known as required mandatory distributions when you reach 70.5. Now let's talk about taxation on a traditional IRA. The money that you put into the traditional IRA is tax deductible, so contributions are tax deductible. But please be sure you understand, as your adjusted gross income increases, if you're also contributing to a employer qualified plan, like a 401k plan or a simple or SEP plan, then as your income increases, your deductibility is phased out. Not the contribution, but the deductibility. Now, whether the contribution can be deducted or not, earnings grow tax deferred. So let's say that my income is such that I cannot deduct the contribution. So I pay tax on the contribution. The earnings would grow tax deferred. What if I did deduct the contribution? The earnings would grow tax deferred. So it does not matter whether I deduct the contribution or not, earnings grow tax deferred. Now, when I take money out of my traditional IRA, that's when taxes are going to apply. And taxes on a traditional IRA would always be the same rate as on your ordinary income. Now, let's say that you put money into a traditional IRA, you were able to deduct the contribution. Earnings grow tax deferred. When you take that money out, 100% of that money would be taxed as ordinary income. What if you contribute the money, but you're not able to deduct the contribution from your taxes? Here your traditional IRA has a cost basis. Earnings still grows tax deferred. When you take money out here, the earnings would be taxed as ordinary income, but not the cost basis. Now, if you take money out before 59.5, there's also a 10% penalty on the distribution, and this would be in addition to the tax. So let's say that you put money into your traditional IRA, you were not able to deduct the contribution. So you pay taxes on that money. Earnings grow tax deferred. You take money out before 59.5, only the earnings would be subject to the penalty. What if instead you made the contribution, you deducted it? You take money out. Now, both the contribution and the earnings would be subject to tax and penalty. Now, exception to the penalty, but not the tax. If you take money out before 59.5 due to the account owner's death, or the account owner's permanent disability, or if there are medical expenses that exceed 7.5% of your adjusted gross income, or if you take money out before 59.5 for educational expenses. Educational expenses for who? Yourself, someone in your immediate family, children, grandchildren. Another exception to the penalty, first-time home purchase. Now there's a $10,000 limit here. First-time home purchase for who? Yourself, immediate relative, okay? Now, make sure we understand, when we talk about exceptions here, we're talking about exceptions relative to the 10% tax penalty, not to the tax. We'd still have to pay tax, just no tax penalty. We continue with traditional IRAs. There are a couple of ways to move money from one IRA to another. One way is a rollover. If we take a rollover, we're going to take a distribution from our traditional IRA. We must deposit that money into another IRA as a rollover within 60 days of the distribution. If we do, no tax, no penalty. Now, we're limited to one rollover per year. So once we deposit the rollover into the IRA, we cannot do another rollover for 12 months. What's another way of moving money from one IRA to another? Transfer the account. This is custodian to custodian transfer. The owner would not take a distribution. We would just move the money internally from one broker-dealer to another. There would be no tax, no penalty, and you can do transfers as many times as you would like. Now let's talk about a Roth IRA. Contributions. Limits are the same as with a traditional IRA. How much could I put into a Roth IRA? 100% of my earned income, not to exceed $5,000 per year. Now, if I'm 50 years old or older, I could put in an additional $1,000 as a catch-up amount, so there your maximum contribution would be $6,000. Now, be careful, be careful. Can I put $5,000 into a traditional IRA this year and another $5,000 into a Roth IRA this year? No, I can't. I've got $5,000. I could put that money into a traditional, or I could put that money into a Roth, or I could split it, but all I got is $5,000. Now, phase outs. What's phased out with a Roth IRA is the contribution itself. As your adjusted gross income goes up, your contribution is phased out. Now, this phase out has nothing to do with your contributing to a qualified plan. Whether you put money into, say, a 401k plan or not, the phase out applies. Now, with the traditional IRA, what phased out? It was the deductibility. With the Roth IRA, what phases out? It's the contribution. With the traditional IRA, the phase out only applied if we're covered by a qualified plan, if we're putting money into a qualified plan. With a Roth IRA, it applies whether you're putting money into a qualified plan or not. With a Roth IRA, you can continue to contribute after the age of 70 and a half, as long as you have what? Earned income. Earned income. Now, distributions will be tax-free as long as when you take the money out, you've had the money in the account for 5 years or more and are 59 and a half years of age or older. So both of those things have to be satisfied. Now, you take out the cost basis at any time, but the earnings would be tax-free only after they've been in the account 5 years or more and you're 59 and a half years of age or older. There is no required mandatory distribution when you reach 70 and a half with a Roth IRA. Let's talk about taxation. Contributions are not tax deductible, so the Roth IRA has a cost basis. Earnings will grow tax deferred, and would be taxed as ordinary income if you withdraw the money. The earnings would be taxed as ordinary income if you withdraw the money. And the earnings would also be subject to a 10% tax penalty if you withdraw the money before 59 and a half years of age. But remember, if you leave those earnings in the Roth IRA for 5 years or more and are 59 and a half years of age or older when you withdraw the earnings, then the money grows tax-free. Both of those things have to be satisfied. Let's talk about qualified plans. The first qualified plan we're going to look at is a defined benefit plan. Now, something I want to say about qualified plans. Qualified plans are business-sponsored retirement plans. Qualified plans are business-sponsored retirement plans. So a defined benefit plan is a business-sponsored qualified retirement plan. Defined benefit plan. Retirement benefits are known. The employee knows when they retire how much their income is going to be paid to them from the defined benefit plan. The defined benefit plan is your traditional pension plan. When you retire, you will be paid a percentage of your pre-retirement income. Let's say that you have money going into a defined benefit plan that's going to pay you 80% of your pre-retirement income. Before you retired, you were making $100,000 a year. In retirement, your annual income paid from the retirement plan will be 80% of that, or $80,000. Now, while the retirement benefit is known to the employee, the amount of contribution that has to be made by the employer to arrive at that benefit is unknown. A defined benefit plan must be adequately funded by an employer. We're going to learn a bit later that there are rules that apply to qualified plans. These rules say that the employer has to adequately fund a defined benefit plan no matter how much the contribution amount may be. No matter how much the contribution amount may be. These plans you don't see around very much anymore, these traditional pension plans, because these plans have driven a lot of companies into bankruptcy. There are a lot of household name companies who have had to file bankruptcy because of the defined benefit plans, because they were having to put so much money into these plans to arrive at these benefits that they basically just couldn't do it any longer. Now, taxation. Money going into a defined benefit plan is tax deductible. Contributions tax deductible. Money grows tax deferred. When would we pay tax on the money that is in the defined benefit plan? At the time of distribution. And 100% of the distribution would be subject to tax, and it would be ordinary income tax. In addition, if you take the money out before 59.5, 10% tax penalty on 100% of the distribution. And with the defined benefit plan, when we reach 70.5, we're going to have to start taking RMDs, might see that on the test, required, mandatory distributions. Required mandatory distributions. Now we look at a defined contribution plan. Here, contributions are defined. The employer knows how much money they're going to put into the plan. The unknown here is the retirement benefit. The employee does not know how much they'll be paid when they retire. Taxation. Contributions would be tax deductible to the employer. Money grows tax deferred. When the money comes out, 100% taxed as ordinary income. If you take the money out before 59.5, 10% tax penalty on the distribution. And when you reach 70.5 years of age, you're required to take a mandatory distribution. Now, types of defined contribution plans would include a money purchase plan. This would be a type of pension plan. Would be a 401k plan. Most of us are very familiar with these. With a 401k plan, the employee would make the contribution, and there may be a matching employer contribution. And another type of defined contribution plan would be a profit-sharing plan. Next qualified plan would be the 403b plan, tax-sheltered annuity or tax-sheltered account. You might see TSA on the test. You may also see the number 403b on the test. Employees who qualify for a 403b plan would be 403b employees and 501c3 employees. Now we see that the 403b employees work for public school systems, and the 501c3 employees work for private not-for-profits. Private not-for-profits. Who puts money into these plans? Employee and the employer. Taxation. Money gross tax deferred. At distribution, taxed as ordinary income. 10% penalty if you take money out before 59.5. Required mandatory distribution at 70.5. Now, before we move off of this information, there is a test question in FINRA's database of questions. You may see this, you may not, but it revolves around the 403B plan. And the question is something like this. A parochial school teacher qualifies for a 403B plan as what type of employee? A, 403B, B, 501c3. Well, you see school teacher, so you think 403B, but that's wrong. 403B employees are people who work for public school systems. This is a parochial school teacher. Now, do the best you can spelling it. Spell check would be probably a friend of mine if I had to try and figure out how to spell this. Parochial school teacher. This is a teacher who works for a private school associated with a Catholic church. That's a private not-for-profit. That teacher would be a 501c3 employee. So be careful, watch for that on the test. These qualified plans, the defined benefit plan, defined contribution plan, these qualified plans are governed by ERISA, Employee Retirement Income Security Act. ERISA establishes eligibility requirements. ERISA establishes funding requirements, reporting requirements, beneficiary, fiduciary responsibility, and vesting requirements. Let's look at each of these in some detail. Eligibility. ERISA says that a qualified plan cannot discriminate. So if an employee is eligible, they must be allowed to participate. Question is, who's eligible? Eligibility. If you're 21 years of age or older and have worked full-time for 1 year or more, you're eligible. Now on the test, this is on the test, how many hours qualifies for full-time? 1,000 hours qualifies for full-time, and that's on the test. Funding. ERISA says that a qualified plan must be adequately funded. So if an employer has a defined benefit plan, they've got to adequately fund that plan to arrive at that defined benefit no matter what the contribution amount. ERISA establishes reporting requirements. When would a participant of a plan have to receive a report regarding the plan? Well, the first time is when they join the plan, and then annually thereafter. When they join the plan and annually thereafter. ERISA says that the employee must be given an opportunity to name a beneficiary to receive plan assets should the employee die. ERISA says that the employer and the administrator have a fiduciary responsibility. Everything the employer does, everything the administrator of the plan does is to benefit the employees. And finally, ERISA establishes vesting requirements. Let's say that you have money going into a 401k plan. When would you be vested as to your contributions? Well, ERISA's vesting schedule says you're vested as to your contributions immediately. Now, there may be tax and penalties when you take the money out, but you're vested as to your contributions immediately. But if they're employer matching contributions, the employer might put in a vesting schedule that says you can't get our money until you've been here for 5 years or 7 years. And that's vesting. Now let's talk about educational accounts. The first educational account we're going to talk about is the Coverdell Educational Savings Account. That's the ESA. How much can go into a Coverdell account? Maximum contribution is $2,000 per person per year until the age of 18. Until the age of 18. So I've set up a Coverdell account for my son. I put $2,000 in the account this year. His aunt wants to put in another $2,000 this year. Can she? Nope. $2,000 per person per year until that person turns 18. Now, income limits apply to the person making the contribution. As your adjusted gross income goes up, you lose the ability to make a contribution. Now, who can contribute to a Coverdell plan? Anyone. So mom and dad make too much money to contribute. Grandma and grandpa can contribute. Anyone can contribute. Now, distributions. Distributions. Money is going to grow tax-free. Money is going to grow tax-free as long as the money is used to pay for qualified educational expenses. Tuition, books, room and board. Absolutely. Absolutely. Spring break trip to Panama City. No. Beer for the weekend. No. I mean, use your good sense as to what a qualified educational expense would be. Now, the money must be used by the time the student reaches the age of 30. What can we use the money for? These educational expenses, for what? Preschool through higher education, through college, and beyond. What if the child the account has been set up for is not going to go to school? The money is not going to be used. The account can be transferred to another child within the same family. Same family. Taxations. Contributions are not tax deductible, so you have to pay tax on the money you put into the plan. Earnings grow tax-free as long as you take the money out to pay for qualified educational expenses. And again, use your good judgment as to what a qualified educational expense is. Also, earnings grow tax-free as long as the money you take out of the Coverdell account does not exceed the educational cost for the year. If we do exceed the educational cost for the year, then we'd have to pay tax on those earnings and a 10% tax penalty. The next educational account would be the Section 529 plan. These are state-sponsored retirement plans. Now, contributions. How much can I put into a 529 plan? Contribution limits vary from state to state, and they're usually very high limits. Not that $2,000 we had with the Coverdell, very high limits. There is a special provision in the Internal Revenue Code that would allow you to combine 5 years' worth of gifts and put into a 529 plan at one time and pay no gift tax. And pay no gift tax. So let's say I'm a single tax filer. We saw this earlier. How much can I give in the form of a gift per person per year and pay no gift tax? $13,000. I could combine 5 years worth of gifts at once and put in $65,000 to a 529 plan and pay no gift tax. But I cannot give this person a gift for the next 5 years. Now, if I'm married filing a joint tax return, my gift limit is what? $26,000 per person per year. So 26,000 times 5, that would be my limit. I believe that's 130,000. That's what I could put into the 529 plan at one time and pay no gift tax. But if I do this, I cannot give this person a gift for the next, what, 5 years. Now, there's no income limitations. So regardless of how much money you make, you can put money into a 529 plan. Distributions. Money can be used for qualified educational expenses. There is no age limit here. So this could be used, money from a 529 plan could be used when the student is older than 30. This money is only available for higher education, which would be post-secondary, college, graduate school. If the person who the money has been put into the account for is not going to attend a place of higher education, then the account could be transferred to someone else in the same family. Taxation. Contributions are not federally deductible. So you put money into a 529 plan, you cannot deduct that from your federal taxes. Contributions may qualify for state tax deduction. When would a state tax deduction be allowed? 529 plans are going to be sponsored by individual states. There's a Georgia 529 plan, Colorado 529 plan, Wisconsin 529 plan. If I put money into my state's 529 plan, I live in Georgia. If I put money into a Georgia 529 plan, the contribution I make, I cannot deduct from my federal taxes, but I could deduct it from my state taxes, from my Georgia taxes. What if I live in Georgia and put money into a Colorado 529 plan? I cannot deduct the contributions from my federal taxes. I also will not be able to deduct the contributions from my Georgia taxes either. Now, money is going to grow tax-free as long as the money is used for qualified educational expenses. What if the money is not used for qualified educational expenses? Then the earnings would be taxed as ordinary income, and there would be a 10% tax penalty on those earnings as well. Now, we have another test tip for you. Be careful about changing answers. When you change answers on a standardized test such as this exam, 75% of the time you're going to change from a correct answer to an incorrect answer. So be careful when you change answers. Only change answers if you're absolutely certain you marked an incorrect answer. Now, one of the test tips I gave you a little earlier was to mark a question for review. Answer your question and then mark the question for review. I would not use that on a wholesale basis. I wouldn't mark 10 or 15 questions for review. That's just going to get you in trouble. I would mark maybe 2 or 3 questions for review. You really want to go with your first instincts. Go with your gut.